Well, first up, behavioural finance was long ago regarded as the touchy-feely aspect of the investment process. When it came to constructing portfolios, there was little regard for the personality the portfolio was supposed to serve. So despite the best intentions of investment professionals, investors became their own worst enemy. The situation has drastically changed in recent times, and Warren Ingram, director of Galileo Capital, believes this is a fundamental aspect of the advisory business. Warren, thanks for joining us. And of course, we've got Warren squared on the desk this evening. Let's talk about behavioural finance. Talk to us about some of the cutting edge trends that we're seeing in the field of behavioural finance.
So I think, as you say, I mean, it's been around for a long time now. Behavioural finance is not new and it's been spoken about a lot, but it's been very difficult to actually see how that works in the real world with real people's money. And what we have seen in the last 2 or 3 years are really scientifically developed risk tolerance questionnaires or processes where people have started to try and understand product providers, etc., trying to understand exactly what it is that their clients are looking for and what they can deal with when it comes to investment risk, especially around investing in shares, which is really then our most risky asset. And more specifically, when the world falls apart and you've invested somebody's money, try to understand before the time how much money they are comfortable losing before they jump off a tall building or tell you to move all their money to cash. And that's really where I think the industry has now progressed.
How's the assessment of risk changed, though? Give us an idea of what was done in the past and how these kind of risk tolerance models now work.
So 10 years ago, you would find there'd be a 10 or 15 point questionnaire, usually some kind of a tick the box approach, which would ask you, very interesting questions like, do you go bungee jumping on the weekend? Do you skydive? Do you like adrenaline sports? Do you like motor racing? Oh, and by the way, how much money would you be comfortable to lose? And those were all useless questions. They didn't help anybody. They didn't have anything to do with actually a person's innate tolerance for investment risk. So what's happened over the last 5 or 10 years is you've got now fine psychologists actually taking this whole area much more seriously. They've actually worked at trying to understand how you analyze those risks and then more to the point, how do you develop a set of questions that will really give you a true result where the advisor, for example, doesn't interfere with the client. It doesn't guide them to a particular result that the advisor wants, firstly. And secondly, how do you understand the person's tolerance for risk irrespective of what's going on in the market? So if the market's booming, that shouldn't affect your understanding of actually how that person can deal with markets.
Warren, this is a key question. We've seen some of those clumsy tests that were done in the past, and that I think a lot of that changed after the financial crisis when financial planners actually had to see how their investors reacted under times of duress and extreme market volatility. But to come back to that point, even if you can accurately assess the risk appetite of an investor, assuming someone is very risk averse, a young person in their 20s, they've got 40 years to save to their retirement, is it in their right interests to structure a portfolio conservatively for them, given that it might not achieve the real returns that they may need to meet their retirement needs in the future?
So I mean that's probably the most difficult question or most difficult situation you can deal with. And I think the answer is that people's tolerance for investment risk does change with education and with experience. So if you're an advisor and you meet that young person, as you say, who needs to invest for 40 or 60 years and they cannot tolerate risk, it's pointless putting them into a high risk portfolio, which is maybe from a numbers point of view what they need to do, and then in the first market crash they sell out. Then you've achieved no result for anybody. In fact, you've really put that person back decades. So I think the answer there is that you would start them in a slightly risky portfolio. In other words, you invest them in something in unit trust speak, a conservative portfolio, let's say. That's not a money market fund. It will beat inflation. And you start getting them used to being in the markets and being invested and get them through a major dip and let them experience that, educate them through that process. And over time, you can gradually increase their exposure to risk. So I think you've got to find a balancing act. I mean, that's the whole point about investing, is it's not a pure science and it's not an art, it's somewhere in between.
And of course, adding that educational element, but these are just better tools to help you understand clients and their risk better, as opposed to kind of, as you say, those old models.
And I think the point is also helping people to understand themselves. When we take people through this process, very often they're actually stunned themselves to realize, what sort of risk they either can deal with that they didn't think they could, or that they come out and they say, no, you're right, I can't deal with that risk. And yes, we need to make a plan.
So give us some examples of how you modify modify investors' behavior now? You know, we've talked about this example where you've got a 20-year-old who has a conservative slant. You know, give us some other examples of how you've used, for example, this risk tolerance model in your own work now.
Well, I think where we see it is trying to get to the point of giving someone the correct allocation to shares, bonds, you know, property, cash, that asset allocation. And very often when you arrive and you meet a new investor for the first time, they've got a particular asset allocation. So let's go to the other example is someone in their 70s who has 100% in shares. Now, they're happy with that. And I mean, financial planning 101, the theory would tell you that that's really not a good idea. I mean, that's really not what you should be doing. Having said that, if their tolerance for risk is such that they can live with that and they have over their entire lifetime, then as an advisor, you need to understand that, and you can't suddenly convert 70% of their investments to cash simply because the theory tells you that's what you need to do. Mm-hmm. As the advisor, what you need to do is try and meet them somewhere in between to give them some kind of a balance to a rather skewed portfolio. Mm-hmm. And I think that's really where I found a lot of the value out of this is trying to take those real exceptions to the rule and try and get some kind of meeting point or middle ground.
Mm-hmm. Warren, we've read some great literature by the likes of James Monteiro, who talks about the 7 deadly habits, behavioral biases that can dramatically influence investors. One of them is overconfidence. I know you deal with quite a few high net worth clients. What do you say to an executive or a high-powered businessman or entrepreneur that very much believes in their ability to invest directly in the stock market and beat the returns that could be generated by using either an index or an actively managed fund? How do you shape that discussion with some of your clients?
Yeah, it's a difficult one. We find our most difficult new clients are advocates and medical specialists because they're always telling you how it is. I think there what we end up doing is spending quite a bit of time talking through real world examples. So in the situation like 2007, leading up to 2008, 2009. What were you doing, Mr. Client? And what was your thought process? Did you call that crash? Because we didn't. Mm-hmm. And what did you do when the market did fall? Did you then go from cash back into shares on the 15th of March 2009, which is really when you should have? If you didn't, and no one did, then let's figure out a process to get you there. But I think talking through real world case studies with them, with their own money, and helping them almost explain their mistakes to you rather than pointing out their own frailties, because that doesn't help anybody. It does help sometimes, and sometimes you just got to say, I'm sorry, I can't help you.
But this brings us to the next behavioral bias that we talk about, is what we call selective memory. And when you ask clients, or you're standing around the bar, you're asking guys how their portfolios, how their trades have been going, they tend to tell you the ones that really worked out really, really well and seem to forget the ones that didn't. So in that situation, is that awareness, is that cultivating that awareness quite important to say, well, hold on, are you giving us the truth here? Did you really do that at the bottom of the market? Yeah. You invest heavily, because that is another bias that people choose to ignore.
So I think the numbers don't lie. So what we do is we try and gather as much information from that client before the time as possible. So we actually sit down, if it's shares, for example, that they've picked, and as you say, they'll only talk about their successes. Having their entire portfolio in front of you when you have the conversation with them, then starts to point out the errors. And without, you can just say, well, talk me through this steel company that you bought a long time ago, and it's now 1/10 of its price. Explain that logic, not so much just the result, but explain the logic of what you did there, because I need to understand you and I need to help you make those decisions, maybe avoid those decisions next time. So I think a lot of this is about actually talking through history with all the facts in front of you. And if the clients are not willing to have that, or not willing to have that conversation, then you've got a problem, because then that selective memory is going to repeat itself time and time again, and usually to my cost. And that's the problem then, because how do we get to the right result for the client?
Another important aspect you brought up is where to invest clients' money. And of course, we've seen the growth of the ETF industry here in South Africa. We've of course seen the returns you can get from ETFs, and we'll see that after the break. But what is your view right now in terms of investing active versus passive with clients' money?
I think that being in an index of some description, especially very low cost, and that's really the driver of this whole decision, is the history has proven time and time again in South Africa Africa and I mean all around the world. The US has great studies about this. It's very difficult for fund managers at high fees to beat the market. I mean, Warren Buffett's got that famous bet with the hedge fund managers, and I mean 5 years into that bet, it's a 10-year bet saying that the index will beat the best 5 hedge funds that they can choose. He's now leading that competition.
After being behind initially for the first 2 years, I think he was behind there.
He was very far behind. And the point there is that costs are a massive drag on performance. So I think for private investors that an index must make up a very significant portion of your exposure to shares.
Your clients' money on the whole is an average amount that is invested in passive investments?
So we've got clients who are 100% invested in the index, whether it be the share index, the bond index, etc., down to somewhere around 70% of their money. So I mean, as an investment house, we are massively in favour of index investing. I think nowadays the indices are also getting a bit smarter in terms of how they're structured, so they're avoiding some of the obvious bubbles, which is always the big criticism of index investing. But to us, we would say the optimal ratio is somewhere around between 80 to 100% of your investments in shares, especially.
We talk about this, and I've got to kind of press you here, Warren, because we've seen some great fund managers. We've got some great fund managers. We've got some great institutional fund managers. Alan Gray Coronation. We've got smaller fund managers like Dave Ford and even, I guess, the value fund manager, John Bickard at Investec, who's having a tough time at the moment, but has proven over the long run that he's capable of beating an index. Why aren't you interested in this very elite? Is it just a factor of being able to consistently beat the index, or do you just stray away from even getting involved in that decision because it's so time consuming?
No, I mean, if the time was well spent, if we could justify and say with a high degree of probability that we could choose the next Dave Ford. Remember, Dave Ford is not under 40. He's well over 50 now. So you know, if you're taking a 15 or 20 year investment view with Dave Ford specifically, that's quite a tough view to make. Is he going to still be committed to the market and committed to investing? And so making those decisions, the probability of being wrong is so high. Whereas if you're in the index, you're going to be right, or you're going to be in the top 80% of all the funds over long periods of time at a very low cost. And it always comes back to that decision of how much return are you going to get for the cost you're going to pay? Do you want to pay a fund manager 1.5%, or if you include performance fees, 4% in a great year, whereas you can pay an index 0.3
and get those returns from the great year
and be right 80% of the time.
What about investors who want to directly invest in stocks? They come to you and they're like, we like Sasol, we like BHP Billiton, we've been watching CNBC Africa, these are the stocks to invest in. How do you incorporate share investments into a client's portfolio? Do you steer them away from that and say, no, listen to us, or do you allow them to have that space?
I mean, I love that idea because I think it's difficult to make investment decisions as a private investor if you're not an investment professional without having some sort of context to how markets are working, how shares are performing. So we always would guide somebody who has that interest. We would guide them to actually having their own stockbroking account, making their own investment decisions. Naturally, they need to do the research. We spend quite a bit of time counseling them, if they haven't done it before, on what they should be doing, how they should be thinking. If we meet somebody who is sophisticated and does make their own decisions, for us that's the best kind of client in the world, because the things we'll be doing with them, we'll focus 100% on the indexed solutions for them, getting the costs out of the system, and allow them to take the active bets against the market to try and get that outperformance, which is possible but very difficult.